So while Steve throws this poll up, this will kind of give us some information about how to have the conversation today. This poll here that we're going to put up talks about some of the reasons for home ownership, because the big news in the room right now is, hey, real estate's changing, interest rates are going up, what's happening with pricing, things like that, and which is definitely a very important part of buying a home and home ownership. But what we're going to try to do today is step back. We're going to go through all the data and then just kind of finish it with a bigger conversation about all the different reasons for home ownership. So we'll put that poll aside here in a second, but that'll be an interesting thing that we'll circle back to a little bit later in the conversation. But what I'd love to do is just start the conversation and address what we're all seeing in the news, and give some validity for that little bit of a knot in the stomach that a lot of people have right now. U.S. Wealth Management, they just put a headline out saying, how far will the market correction go? And then the Wall Street Journal, I think they pretty accurately describe what's happening right now. And they said the Fed pricked the everything bubble. And I think that's probably a little bit exaggerated when it comes to housing. But I do think that what the Fed intended to do, and to really kind of soften demand and try to bring down inflation throughout the market, is having its intended goal achieved. So we're seeing that start to happen. And then a lot of people are saying, okay, well, obviously interest rates are going up. How does that affect housing? And there's a lot of people that are, feeling some panic in the room, and we want to address that. That's a very real feeling. But what we want to do is inform ourselves with data. And when we look at the data, it's definitely more nuanced than those headlines may lead you to think at first reaction. So, but before we get started, I'm going to try to be very succinct today. I want to honor everyone's time for joining here. But I just want to give a little caveat that we're going to do our best to educate today. And we feel that we can definitely provide some expert opinion, but we can't be perfect. So, there's a difference between experts and perfect. And I think anyone who says that they can perfectly predict what's going to happen in any market, whether it be equities or the housing, is fooling themselves and fooling others. But we're going to definitely do our best to help digest and interpret this data, and be a voice of reason during these times. So I'm having flashbacks. These are conversations that we had back in February, March of 2020, right? When there was kind of a similar feeling in the market.
Absolutely. Yeah. I mean, when you get to these moments, you have to look at it and go, what are we seeing? What are we feeling? Those can be very different things, right?
Yep.
And then also, what are we anticipating? And we have an idea of what we expect to come, but we've got to be really in tune with what people are saying and what the data is showing, and just be ready to advise as we see things continue to evolve. There is no set formula. There's no set answer. And like you said, anyone who says there is right now, I think is fooling you and fooling themselves probably.
Yeah, well, and the thing about housing is that it goes above beyond speculation and investment. It's an important part of people's lives. And, we had people both enter and exit the housing market in that first and second quarter of the pandemic in the early 20s. And they did very well in a time where a lot of people were sitting on the sidelines. And I think that there's always, wise moves to make. And it just kind of depends on your goals, your timelines, your risk threshold, things like that. So we're here to arm you with that information today. And hopefully this will be of value to you. So let me just jump over to the next one here and get started. So what we're going to talk about today are three main points. One, what is affecting, happening here in the housing market right now? Two, is this a crash, a correction, or return to normalcy? And then three, how does this affect my personal strategy? So we're going to go to those three main points, and we're going to kind of weave those into the conversation today. Please add questions as we go along. But I think where we should really start this conversation is interest rates, because this is the big one that is affecting us all, and we're seeing it. And Steve, do you want to kind of take the lead and to have that conversation here?
Yeah, absolutely. I think you're right. This is probably the biggest headline. I mean, it's certainly timely just with what we're seeing in the markets and what we've seen over the course of the last year. Again, when you're looking at data, there is always this tendency to kind of look at the most recent data. And I think, what we're trying to do here is just show historically. And I know people have probably seen this, and they know historically that back in the 80s and 90s, interest rates had gone up into the teens. But I do think it provides some perspective to say, okay, we know we were in an artificially low interest rate period for the last number of years. There are a bunch of reasons for that. We would be happy to host another webinar or dig in on a conversation on the side about that. But we are seeing this go back to more normal levels. We are still historically lower than where we have been for a good chunk of the past, but it's rising, and it has risen quickly this year. And I think this next slide will allow us to kind of see what we've seen so far this year, which is we started the year at about 3%, and we've worked our way up to 5%. And over the course of the last couple of weeks, we've seen that tick up even higher. Brian, did you have something you wanted to add?
Yeah, just before we jump ahead, this is basically a 50-year chart on interest rates. And what it basically shows is that if we go back any decade, excluding 2010 to 2020, the interest rates we're at right now are right about the historical average. But what's interesting is especially the data that we've just been given this week with the Fed raising the overnight Fed funds rate. What was that, 1.5 this week? We haven't seen a rise of this amount in this short of time. And you and I were just talking about this, and there's very few data points in history where they came on and reacted that quickly with interest rates. I think that 1980 was probably the most similar time as far as interest rate rises. So we're in a little bit of uncharted territory here as far as the pace of it. But when we look at the rate of it, it's still pretty normal. All through the 90s, interest rates were between 7 and 8%. In the 80s, the interest rates were 10% plus. There were times in the 17s, and then back in the 70s, they were between 7 and 10%. So we do have to kind of readjust our head a little bit and say, hey, we're not at 3% anymore. But if we look at the last 50 years, we're still below that average. But it is a little bit of a shock to the system. And then a lot of people do see this as a more short-term reaction to the inflation, and these interest rates will come back down. But in the near term, we're dealing with some interest rates that are a little bit unprecedented for our time.
Right. And one of the things that we were also talking about was not only are we coming off this low interest rate environment for the last couple of years, but as we come out of that, we've paired that with stock market movement. And when the stock market, there's a tendency in the stock market, when the stock market goes down, that people flight to quality. So they go to the more stable investments like treasuries. And at the end of the day, that is what mortgage rates track, is treasuries. And so as these treasuries have ticked up, that has caused these interest rates to tick up. So we've combined it, inflationary times, coming off a low interest rate environment. And so I think a lot of those factors are the reasons we've seen it escalate as quickly as we have. But as this chart shows, we went from about 3% to 5% and then seemed to have plateaued for about a month and a half stretch. But just, this chart, the last bar on this chart is early June. We're obviously in mid-June now. And in many cases, we're in that 6.5% and 7% range now for a 30-year fixed. And I would say this is a good time to answer that question that we got. The whole home buying or home selling process it really should be a team effort. It should be involving financial planners, lenders, your sales associates, your brokers. But this is where you talk to your lender, because there are options. And so someone had brought up the question about an ARM, and it's an adjustable rate mortgage. So basically, these had kind of gone out of fashion for a little while, but we're seeing opportunities now where people can get into, say, like a 10-year ARM at a discounted rate, when for the most part, many people don't stay in their homes past 10 years. A lot of people do turn and sell a house within a 10-year period. And so there are some very good strategies that you can employ with your lender to work through what makes the most sense for me. If you're buying a house and your plan is to turn it in a year or two, that's going to be a very different proposition for someone who's buying their forever home and they're going to live into it for the next decade or two. So we would say, yes, absolutely, ARMs are an option, but we would also say we are not the experts on that. And we would highly recommend getting in touch with a great lender. And we certainly have worked with a number of them and can recommend some. Go ahead, Brian.
Yeah, no, there's a lot of good conversations around ARMs happening right now. And I think it was a good product that was poorly used, if anything, during the last run up. I don't believe that people should be getting loans that they can't afford with timelines that as soon as that rate adjusts, they're upside down in their payments and they can't afford it. But for people that have enough down payment, are well qualified, but don't necessarily want to jump into these interest rates like what we just saw jump, almost 2 points in the last week. If they want to kind of bridge that hump and feel confident either that, like you said, they're going to be selling their property in the next 5 or 7 years, or they have enough down payment that if it adjusts or whatnot, or they're going to watch for that interest rate to come back down, it's a perfectly good way to enter this market. But let's talk about this. I mean, so prices are still high. So obviously, we're, the median price right now in Bend is $715,000 for a single family home, which is uncomfortably high. But we have seen the Fed did what they were out to do. They wanted to ease demand. They wanted to slow everything down. They wanted people to spend less money. And we saw it. It thinned the buyer pool. And you can see it on the very end of this graph where the last month or two prices stepped back a little bit. And to be honest, that's kind of trailing data. That's, when we have closings here in May and June, that's really means that those sales happen in February, March, or April, right? And so, as we continue to feel some of the slowdown now, I think that trend is gonna kind of play out in the months to come. But Steve, how are you seeing it on the front lines and in your negotiations right now?
So, we're seeing a number of things. So we just had someone pop up with a question about price adjustments as well, and what we're seeing in terms of price adjustments. And so that's got a couple different tiers to it. And so when we're talking about price adjustments, that is based on where a seller and a listing broker thought the house should be valued, where they were putting it on the market, not always at an accurate price. We are definitely seeing that buyers have become more patient, whether it's out of choice or back to interest rates or their buying power. If it's being forced, that they need to be more patient and they need to adjust their price point or wait for a price to come down to a certain level. And so we have seen price reductions tick up pretty substantially this last month. And I think part of that, there's often an inclination when you see price reductions to think the market's falling. But it is not always an indication of that. There are a good number of those price reductions that needed to happen to get to the actual accurate pricing of where that house should be or that property should be.
Yeah, any change is tough, and we're definitely at an inflection point. I don't equate it to a bubble popping at all. The data is so different than housing bubble 2008. But we are at an inflection point, but there's changing and changing factors. And when that happens, there's always a shuffling about. And I think the biggest thing, and you alluded to, is getting buyers and sellers on the same page, because a lot of these sellers who aren't in the business every day, they've been seeing this trajectory. If you look at from 2020 to now, it's been this strong upward, up into the right price appreciation month over month, and they just extrapolated that, and they're like, hey, if my neighbor's house sold for this, I'm going to price it for 15% more, et cetera, et cetera. And there was really, it's going to take some time for those sellers to realize that they couldn't over extrapolate. We had that inflection point and they need to be more realistic. And so I think that a lot of the price reductions we're seeing, like you just said, aren't real price reductions off of current price. They're off of prices where they over extrapolated and were simply unreasonable and only worked in a rapidly appreciating market. And then there could be some real price reductions in the near future, but I think it's going to be more on kind of the grade and the quality of the properties that we're going to see it in. Steve, are you seeing it there as well?
Yeah, absolutely. I mean, we have this time in the market right now where days on market are ticking up, and there are some homes that have been sitting on the market for 50, 100 days. But at the same time, we've got multiple offer situations. And so we've got the homes that are dialed in and priced accurately out of the gate. They're still selling, and they're selling competitively. The average list to sale price right now is still actually over list price, even though that's
Yeah.
come down from about 103% to about 101%. We have both ends of the spectrum going on now. So yeah, absolutely.
Yeah, so I mean, and for what it's worth, Realtor.com just came out. Their head chief economist, Lawrence Young, said that experts don't believe the housing market's in a bubble or crashes in the cards like during the Great Recession. The nation is still suffering from a housing shortage that has reached crisis proportions at a time when many millennials are reaching an age when they start to consider home ownership. That's likely to keep prices high. So obviously, this can be interpreted a bunch of different ways. Whether you agree or don't or disagree, there are some real factors to housing that we need to discuss. And we've talked about this in the past, that housing is not directly tied to the overall economy. And I believe it was in 3 of the last 5 recessions, housing prices went up. 1 was flat. And then the one that went down was the most recent, the 2008, right? Or I guess we could add another recession. I think there was a 1 or 2 quarter recession in 2020 that they made official, and prices obviously went up during that as well. So a lot of people say, oh, the stock market's correcting, how, housing prices must be going down, or there's a recession, housing prices might go down. Housing is really a bigger thing that's just a supply and demand curve. And historically, when supply gets to be enough, there's a saturation, the builders overbuild, the buyers have things to choose from, the builders kind of close down, prices go down for 1 or 2 years, and then they have it was like a 7-year up and about a 2-year fall. It was kind of that ebb and flow that was the case for 50 years. But what we're really dealing with right now is a historic shortage of housing. I'll get to that in a second. But this is coupled with increased demand. So this is a chart. This was the 2020 chart. So it's moved over 2 bars since then. But this shows the demographic trends. This is population at any one age, how many millions of people there are in the US. And the 2 that we should really look at are, 1, the baby boomers. They're starting to taper off into their later years and become a less of a force in the home buying, although they're a little bit more of a force in the home selling, but it's kind of different product type. But the one we have to watch for is the biggest wave of population that we've ever seen in the US are the millennials, and their average age now has now ticked up to 30 years old. And 30 is the magic number. 30 is the most likely age where people have household formation. And then the 1 or 2 years after that are when they start buying homes. So we're at the beginning of about a 3 to 5 year run of the millennial generation coming into their peak home buying years. And we have a massive housing shortage. So, it's kind of a very different time. And this is a graph that we've shown before, but this is really, there's a lot of factors that go into this. But basically, after that housing great recession of 2007, 2008, builders stopped building. Banks stopped lending, developers stopped getting access to capital to put in new lots. And we went for 10 years, we went at about 50% of the historical average of building homes, both nationwide. And it was actually probably more pronounced here in Bend. We went from 3,500 homes a year down to a couple hundred. And so we have this hole of homes, and we're coming into a time where there's more demand for houses than we've ever had. And I'm not saying that this is going to, plow prices up through, the economic, instability that we have right now. But what this is showing is that we're in a very different world, and we have such a supply constraint right now that it's, a lot of good economists like, Lawrence Young from Realtor.com saying that, hey, he doesn't see prices really going anywhere, given this supply shortage. But we also haven't seen times where interest rates have gone up 3% in a matter of a month. So we have conflicting factors, but I think this is one that needs to, we need to pay heed to the data that we're seeing here on this shortage.
Yeah. So I think, building off of that, it's interesting listening to you, because even as you're talking through it, it's a little insight into what we do, right? We look at this data, and there's an indicator that it could be this way, and there's an indicator that it could pull it this way. And so, you're always a little bit conflicted with going back to interest rates. At the start of the year, as we saw interest rates going up, there was this discussion of, is that going to put people on the sidelines? Well, it actually didn't. It actually got people off the fence in the late winter, early spring. It got people off the fence and said, I want to get it while I can at 4 before it gets to 5. And it wasn't until it got to about 5 where it seemed to plateau the demand a little bit. And so, same with some of these things that we're seeing with pending sales. So, this next chart is showing that on average, on a 12-month rolling average, we do about 4,500 homes a year, or that's where we're at right now. I shouldn't say that's what we do, but that's where we're at right now if you look at the data based on the numbers. But historically, that red bar is a historical 10-year average, and that's closer to just over 3,000. So I'm sorry, just over 3,500. And so, there is a significant drop that we can have in pending sales, which is absolutely what we expect to happen. There is no scenario where interest rates go up and people have less buying power with where the stock market's at right now, where it doesn't affect the number of transactions that are taking place. That's what it is. And so we've already seen pending sales kind of taper in relation to the new listings that are coming up. If you didn't catch our last newsletter, we dove into that in one of our sections, and so you can take a look at that. But we absolutely expect these pending sales to continue to slow down throughout the rest of the year. But again, this is just a historical perspective on, we expect that we'll be going back to more pre-pandemic levels, which is that whole concept of a return to normalcy, as opposed to, a big correction. Anytime you see, this reminds me of some of the other headlines we've seen in the past of foreclosures are spiking, or it's all relative to the other factors and the other, what was taking place just prior. So,
yeah,
I don't
think
know.
it's a good point to talk about. I mean, if buyer demand were to go down by a third, we're still at a 10-year rolling average. And no one said that the housing market was going to crash in 16, 17, 18, 19 because there was only 3,500 homes sales. So whether it goes below that number or not, we're gonna watch that data and we'll let you know. But all we're talking about is there's some buffer here because of these unprecedented times that we're in. And I think that really plays out here in the inventory chart. Steve, do you want to talk about this a little bit?
Yeah, so months of supply, we've talked about it previously, and what inventory is. It's the number of months it would take for houses to turn over based on the current sales pace. And, so one of the things that we're looking at with this, we have seen inventory. I mean, again, it's pretty clear from this chart, historically low, even with the increased rates and the slowing of demand, we're still at low levels. We have come up. It depends on what data points you're looking at and what sector of the market, but we have come up in inventory from, in some cases, a half a month to a month and a half, in other cases, 2 months. But generally speaking, what people call a balanced market is right around that six month mark.
Yeah.
And so,
sorry. So
go
yeah,
ahead,
you're
continue.
right. Yeah. So if 6 months is a balanced market, this is usually when there's kind of balance between buyer and seller. You've got modest appreciation or moderate appreciation. And when you get above that 6 months, as you approach that 9 month to a year, that's where you have the oversupply that really starts driving down the prices. It's not necessarily interest rate. It's not necessarily the stock market. It's not necessarily these other things. It's when you have homes sitting on the market for 9 months, 12 months, et cetera, and not selling, that's when sellers start ratcheting down the prices. And if you compare, I put up a 9 month line here. That shows you how far we have to go. So if we're at 2.2 months of inventory right now, we could have a multiplier of 4 of the amount of homes that are on the market before we start to get to where we start to get that downward pressure on pricing. Obviously, a little unprecedented time with these interest rates, but we're just talking about that buffer that we have right now that hasn't played into previous housing corrections. So we're just seeing some downside resistance. We're not saying that prices aren't going to correct a little bit or who knows what, but definitely it's not a crash. So when we asked at the beginning, hey, is this a crash, a correction, or a normalization? I would put a big red X over crash. Whether is it a correction or a return to normalcy, I'm more in those camps. And there's a lot of people that are supporting that type of opinion as well. I think that this one we should talk. Steve, you're an econ guy. Let's talk about inflation and because we are in inflationary times, how does that relate to housing?
Yeah, so it's again, along with interest rates, it's probably one of the biggest headlines. I think CPI came out at the end of last week, and people are seeing CPI at levels of 8.5%, which is higher than they've seen in a long time, over a decade. And so when you take that into account, people hear that and it's scary. But I thought this quote was really a good one to share, which was, real estate is one of the time-honored inflation hedges. It's a tangible asset, and those tend to hold their value when inflation reigns, unlike paper assets. More specifically, as prices rise, so do property values. So inflation means that your buying power is actually going down. The cost of everything is going up. And so what you want to make sure of is that you've got assets that are appreciating with inflation, so that as the and I think this next chart actually shows what has happened historically in periods of inflation. And so this goes back to the 1970s, and it shows the inflation rate, and over that same decade, what home prices have done. In all but two of those times, home prices have actually outpaced inflation. There, and the couple of times that it didn't were in the 80s and the 2000s, where it was essentially a wash. And so for people that have means and have funds and have assets, they want to have it in things that can hold their value even when the value of the dollar goes down and the prices of things go up. They want to hold something tangible, because that piece of paper doesn't do as much. Having the house that's increased along with the prices of everything else does.
Yeah, I mean, if you put money in the bank right now, it's going to be worth 8% less next year. So, it's a nuanced conversation about where to put money and what does owning a house mean, and what is the true cost of ownership during that time. But what was really interesting, we were reviewing this data this morning. This was an investment firm from Canada advising their clients where to put money right now during these inflationary times. And they had a return protection kind of projection versus a risk volatility. And what was funny is one of their highest recommendations, they have gold as like the gold standard, right? For inflation, you go bury it in the ground. It has pretty good high return protection, low volatility. But number 3 on that list, US housing. So while we may be afraid of what's happening here a little bit, international clients are saying US housing is one of the surest, safest bets with the lowest volatility risk for the next, foreseeable future. So I think that was just interesting to see. This just came out this morning that the Canadians are saying, hey, inflation's high. Where do we go put the money? Dividend stocks, gold, that has some commercial REITs, but US housing. And I thought that was an interesting perspective on what's happening here.
Absolutely.
So let's talk about this a little bit now, and we're kind of wrap this up pretty quickly today because I want to honor everyone's time. So if you have any questions, bring them to us. But this is one where I like to kind of take a step back and say, housing is a nuanced conversation, and it's really about time in the market, not market timing. I've said this before, but I put together a few data points, and this is housing prices in Bend dating back to early 2000s. It showed our first peak in 2007. And then between those two green arrows was the greatest housing correction in the history of the US. So this is as bad as it's ever been, as bad as it'll be, hopefully, that we'll ever see in our lives. This was unprecedented. And what it showed is this: in the worst case scenario, it took about 10 years for that price to become whole again on average, which was really tough for a lot of people that had to hold that home for those 10 years. But I want to kind of give perspective that it's time in market that heals these things, because historically housing has been a very reliable investment tool, part of your financial foundation of your life. And then obviously we're at that $715,000 today. But then what I also wanted to talk about, and this is where we're going to start to get into some of those other factors of home ownership. Even if you bought the house at the absolute peak of the market in, what was it? I think March of 2006, and you had to wait it out to become whole again as far as the purchase price. What else happened during those times? Where did you live? Did you have security, et cetera, et cetera? For some people, it might have been too much. They couldn't have afforded it. But another factor in it is, where are those mortgage payments going? You had to live somewhere during those 10 years. If you were renting during those 10 years, that money's just gone and out the door, and it's paying someone else's mortgage. But I ran an amortization chart on a $250,000 loan. And in the first 10 years of a mortgage, there's over $50,000 in principal payments. So even if you say, hey, my home didn't appreciate during those 10 years, what else happened? Well, I paid down my principal $50,000. So, there's $50,000 in returns right there. And this is where we start to get into bigger strategy. And that's why this is not a binary yes, no answer for anyone in this market. This is where you need to be strategic, and you need to have, a very good plan in place. And Steve, I'd love for you to address these, because you do such a good job at that.
Yeah, so I mean, this goes back to what I had said before. I mean, this really is a team effort. It's a you have your team in place to help you decide what what of this data of how it directly affects me. And that's why I started the conversation with let's turn this into a conversation specifically about you, because there are so many things more to housing than just any one of these data points that we've gone through. Like you said, there are tax benefits, right? There's capital gains exclusions and mortgage deductions, and if it's an investment property, you have different things that you can carry, and so there's all kinds of things that you can do with that. There's the benefit of equity over time with payments versus renting. Like Brian, like you had just said in that last one, there's a certain amount that's going out in rent that's just lost. Your mortgage payment includes a portion of that as principal that you're paying back to yourself. What does it mean to you to have the predictability of knowing where you're going to live, and that as a renter, you're always kind of subject to, is that house going to sell? Is something going to happen with the landlord that I'm going to have my life situation affected? It's a very
Are
real thing.
they, yeah, are they going to raise rates on me? And the thing about purchase price is when you actually look at, like, if you were to hold a loan to term for 30 years, the majority of your purchase is an interest rate, not the principal. And when you can fix that rate, there's a lot to be said there, because when you fix what your monthly payment is going to be for the next 10 years, a 5 or 10% fluctuation on purchase price has really little to do with that monthly payment. And so, to have that stability of being able to establish your budget so you know how much is going to housing, things like that, is not a guarantee. Obviously, you're doing renting. And we're not saying that everyone should be homeowners right now and everyone should be buying, but these things need to be taken into consideration.
Yeah, absolutely. I mean, those last couple things on here as well, the stability and security, and staying put and building relationships in a community. And, that goes back to, just Bend in general, as we talk to our clients who are living somewhere else and wanting to move here, it's a conversation that we need to have. Does waiting make sense? If trying to time the market, we know, is a difficult task. I certainly know that in my last career as a trader, that it's virtually impossible to do. And so then you do have to ask yourself the question, why am I moving? Why am I selling? Why am I buying? Is it time to move on and go experience something new? And those are real factors. I think you'll find a lot that we love to go through the data and we love to pull up the charts and talk the numbers. But at the end of the day, when we're talking to clients, usually one of our first questions is why. Why are we
Yeah.
having this conversation? Before
Yeah.
we get into the nuances of everything, why are we doing this? And that can tell a lot. And I think having some perspective on that, I think, is super valuable. And so we didn't quite
No.
keep it to 30 minutes.
Well, it's close. I did see one or two comments come up, and I saw that Gary raised his hand a few times. I'm not sure what he has a question about. Maybe you could throw that in the chat. I saw another question come up by Brian, and he's saying, why so many price reductions? I think that we addressed that a little bit earlier. That the price reductions really are on the houses of where the sellers extrapolated really what was happening end of 2021, very early 2022. They extrapolated beyond the turning point which we have in the market, and we're really just bringing those back down to earth of saying, okay, this is where we're at right now. We're not seeing wild appreciation, and you overshot, and we're starting to see some increased competition. And this is where, as a seller, you can't be sloppy with your pricing. And there's a bit of a psychology here too, where unfortunately, while we're on the front lines and we see this data, our sellers are only selling one house, right? And we're, just because we're doing it every day doesn't mean that we're living that experience. And a lot of them saying, hey, I have to try it at these higher prices. My neighbor sold for 10% over asking price in January. I'm going to give it a shot too. And unfortunately, some sellers just kind of need to go through that emotional experience of having the home on the market for a month or two without offers to kind of really understand what's happening in this market. And that's kind of their personal journey that they need to go through to really sleep at night knowing that they maximize the sale of their price. So I think that's where the majority of the price reductions are coming from up to date. And then we'll see, I think it's not going to be many real price reductions over kind of 2021 prices, things like that. I think it's going to take a lot of factors to build up to that point. And then the other question that I saw here is about feeder markets. Feeder markets are an indicator of what's happening, what the future brings in Bend. What are our feeder markets showing? So I had two good conversations today. I had a conversation with one of the leading agents and teams in New York City. We talked about what's happening in Manhattan, what's happening with international investors. Then I had another conversation with the leading team in Knoxville, Tennessee, and what's happening there. And it's pretty nuanced. They are still making some groundbreaking sales there. You know, these high-end sales are selling faster than they've ever sold for the highest price per dollar, et cetera. But they're seeing what we're seeing. This is not like in 2007, California was dead, Bend was still going for 9 months. This is, other markets are seeing what we're seeing. Buyer demand has diminished. The interest rates have driven out about a third of their buyers. It's decreased affordability. It's hard for a lot of people to buy homes, but yet they still have a shortage of homes. So it's kind of at a standoff. And what I'm getting from them is that the houses have to be priced right. The grade A homes that are prepped, that have a good strategy around them, that are staged, that look right, that don't have deferred maintenance, are still selling quickly. But the buyers are just being a little more choosy. But I don't see any real definitive points of worry yet. It's more, you know, kind of what we're experiencing here in Bend. And I think that's also a sign of kind of where Bend is at. Bend is a more mature housing market. This isn't the speculative second home market of the 90s and early 2000s. We have a real economy here that's more tied to bigger factors. And I think we're just kind of maturing as a housing market. So wonderful. Well, Steve, do you have anything to add today?
No, just thank everybody for their time. It's fun for us to kind of go through some of what we're seeing daily, what we're reading. We'd love to continue to share this with you. We've got newsletters that we put out, and would love a call and dig into the details and how it affects you individually.
Perfect. Thank you, Steve. Thank you all for joining. And we'll send you a copy of this when we're done. And feel free to share this with whoever you can. We'd love to have these conversations.
Thanks,
Have a
everybody.
good weekend. Take care.